Hi everyone, welcome back to XRax School. In today's first chapter of this long documentary, we begin with one of the biggest transitions happening in the front of our eyes. The transformation of global money. The world financial system is entering a new stage. One that will completely reshape how people save, earn, move, send, invest, and store their money between 2026 to 2035. For decades, physical cash, traditional bank, and slow financial system control the world, but now a new digital era is emerging. An era where money is no longer just paper or numbers printed by government. It is becoming programmable, intelligent, instant, and borderless. This chapter sets the foundations before we dive into future digital currencies, AI banking, tokenized assets, global payments rails. On the collapse of all financial models. We need to understand the force that started this shift. The story begins with trust. For years, people trusted bank more than technology, but after multiple economic shocks, inflation waves, global recessions, and the rise of digital alternatives, trust has started moving away from traditional system and towards technology. People no longer ask which bank is safe; they now ask which technology is faster, smarter, and more secure. Around the world, millions of people are already living a financial life that does not rely on physical bank at all. Remote workers receive payment online, businesses run entirely on digital wallets, countries experiment with their own digital currencies, and global companies are building payment systems that work across borders without middlemen. But the real began after 2024 when three major transitions took place at the same time. Governments started exploring digital currencies, companies started automating financial decisions with AI, and individuals began adopting digital payments faster than ever even before. By 2026, this momentum turned into a global movement. In this new world, money behaves differently. It moves in seconds, not days. It crosses borders without friction. It connects people who never had bank accounts before, and it opens doors for new global opportunities that were impossible in the past. Indonesia, India, Europe, and the Gulf, even the United States, are now moving in the same direction, building new financial structures that replace old systems. Businesses are shifting from cash flow to digital flow, workers are shifting from local jobs to global digital opportunities, and banks are shifting from physical branches to AI powered platforms. In this chapter, we explore the foundation of these revolutions. We look at the rise of digital adoption, the shift in global trust, the transformation of financial behavior, the new power of technology, and the early sign that the traditional finance model was reaching its limit. This chapter explains the why the world needed a new financial model, why technology became more trusted than institutions, why global money had to evolve into something faster, smarter, and more transparent. Why 2026 became the starting line of the new financial era. By the end of this documentary, you will understand how money will function by 2035 and how this transformation will reshape the life of every individual, every business, and every nation. This is XRax School. Let's move to chapter 2. For decades, cash dominated human transactions, coin bills, and physical currency were the backbone of economics, defining trades. For decades, cash dominated human transactions, coins, bills, and physical currency were the backbone of economics, defining trades, wealth, and daily life. People trusted banks, stored money in wallet, and exchanged paper money for goods and services. It was simple, familiar, and universal, yet as technology evolved, the limitations of cash became glaringly obvious. The world moved faster than paper money could follow, and humans demanded a financial system that could match the speed, scale, and complexity of modern life. By 2025, the shift had begun in earnest. Digital payment system had expanded to nearly every corner of the globe. Smartphones became wallets, apps replaced cash registers, contactless payments became the norm in countries like Indonesia, India, China, the UAE, and Europe. More than half of daily transactions were already cashless. The convenience was undeniable. Instant transfers, real-time tracking, and the ability of send and receive money anywhere, anytime, completely changed the behavior of individuals and businesses alike. This transition was not purely technological, it was a behavioral. People began questioning the relevance of carrying physical money. Long queues at banks and ATMs become frustratingly obsolete. Hidden fees, slow transfers, and paperwork heavy system pushed individuals and companies toward digital alternatives. Governments and regulators saw his shift not as threat but an opportunity. With digital payments, transparency increased, tax collections became more accurate, and the fight against fraud became easier to manage. Small business led the digital revolution. Shopkeepers, restaurants, and local service providers began accepting payments through the QR codes, mobile wallets, and bank apps. Suddenly, even the smallest transactions became traceable, efficient, and instantaneous. Online marketplaces grew at an unprecedented rates, enabling millions to sell products and services without needing the physical cash. Digital adoptions created a new level of financial inclusivity. Millions of people who had held never a bank account could now participate in the economic, receive payment instantly, and even access credit through digital systems. Global remittance, a historically slow and costly process, were transformed by digital methods. Sending money across borders that once took days and hundreds of dollars in the fees could now be completed in seconds with minimal cost. Platforms powered by blockchain, stablecoins, and cross-border digital wallets started connecting countries in real time. Freelancers, remote workers, and gig economic professionals suddenly had unprecedented access to international payments. Geography no longer dedicated opportunity access. A digital literacy did. Bank, however, faced an existential challenge. Traditional branches, paperwork process, and cash-heavy system began to lose relevance. AI-driven financial service started taking over customer support, credit assessments, fraud detections, investment advice. By 2026, travel banks had already moved to digital first models where the majority of services were automated and conducted online. Customers no longer needed to visit a branch. Financial interactions were seamless and digital. The rise of central banks' digital currencies or CBDCs accelerated this transformation. Government began issues their own digital currencies, integrating them into national and international payment networks. CBDC has allowed instant settlements programs, money, and automatic taxation. The result was a system that combined the speed and flexibility of digital currencies with the trust and regulations of central banks. Countries completely developed the most efficient system payment infrastructures, creating a global race for financial supremacy. As cash declined, a new financial literacy became essential. People needed to understand digital wallets, mobile banking apps, security measures, and online investment platforms. Business needed to integrate their accounting, payrolls, and invoicing into digital systems. Individuals and companies alike had to adopt a risk began left behind. Early adopters gained a competitive edges, accessing global market faster, earning more efficiently, and managing their wealth with unprecedented control. By the end of this chapter, it becomes clear that the fall of cash was not simply a replacement of the one medium with another. It represented the birth of a new financial ecosystem, faster, smarter, and more inclusive and inherently digital. The rules of money were being rewritten, cash was fading, and in its place, digital economics, instant payments, and global financial connectivity were emerging. This transformation set a foundation of AI banking, tokenized assets, blockchain payment, and intelligent financial system that we will explore in the coming chapters. The global shift away from cash in more than convenience, it is a revolution and financial behavior as opportunity. As money becomes faster, programmable, and borderless, it challenges every assumptions about wealth, security, economic participation. Those who adopt early will thrive in this new digital landscape. Those who cling to the old ways may them find themselves increasingly isolated from the global economy. This chapter had laid the groundwork for understanding why the fall of cash was inevitable and why digital systems were not just futures, they were present. Indonesia, Asia, and the rest of the world in witnessing this transformation firsthand. The era of instant, borderless, and intelligent money and begun. It will define the decade from 2026 to 2035. The traditional role of banking has been changing at an unprecedented pace for centuries. Banks were the gatekeepers of money, controlling deposits, loans, and financial transactions. Customers visited branches of wealth and tellers waited in long queues and navigated paperwork. While this system worked for hundreds of years, it could not adapt to the demands of the digital era. By 2026, by pressure on banks to modernize become undeniable. Banks began integrating artificial intelligence into almost every aspect of their operations. Loan approvals that once required days of verifications and human oversight could now be completed in seconds. AI systems could assess creditworthiness, detect fraud, and even predict financial risk with far greater accuracy than humans. Fraud detection moved from reactive to proactive, using predictive algorithms to stop suspicious activity before it occurred. AI also helped banks personalize customer experience, offering tailored financial advice, investment recommendations, and automatic saving plans. The physical branch model began to decline rapidly. Many banks reduced their numbers of branches for seeking instead of digital transfer and mobile application. Customers no longer needed to physically visit a bank to open accounts, transfer funds, or invest in stock. Every service could be performed online, often without human interaction. The digital first approach drastically reduced operational costs for banks while increasing convenience for customers. AI also transferred the internal workflow of bank office operations, which historically required large teams, was streamlined through automations, account reconciliations, compliance checks, auditing, and reporting become nearly instantaneous. Employees shifted from routine tasks to strategy roles, overseeing AI system, analyzing data, and making high-level decisions. This shift made banks more efficient, scalable, and capable of serving a growing global customer base. The rise of mobile banking and digital wallets further accelerated this transformation. With the ability to conduct transactions anywhere, anytime, customers increasingly relied on apps instead of branches. Peer-to-peer payments, instant cross-border transfer, and integrated digital financial service became standard expectations. Banks had to adopt quickly or risk losing customer to financial company. Digital wallets, emerging blockchain-based platform. Central bank digital currencies (CBDCs) played a significant role in this transition. Bank integrated CBDCs into platforms, allowing customers to hold digital currency directly in their bank account. The transaction becomes instantaneous, programmable, and fully traceable. Governments could implement policies efficiently while customers enjoyed in parallel convenience and security. The transformation was not limited to urban areas. Digital banking penetration expanded into rural and previously unbanked regions. Mobile apps, biometric verification, and simplified onboarding process allowed millions to access banking service for the first time. The financial inclusions resulting from AI-driven banking created opportunity for small business entrepreneurs and freelancers to participate in the global economic. Banks also embrace blockchain technology to improve security, transparency, and speed. Internal ledgers, payment processing, and cross-border settlements were streamed through distributed system, reducing reliance on centralized intermediaries. This increase efficiency while minimizing errors and potential fraud. By 2030, the banking landscape was fundamentally different. Traditional banks still existed, but their role was primarily as a technology platform rather than a physical institution. Customers relied on AI system, financial guidance, investment planning, and automatic money management. The concept of a bank's teller became largely obsolete, replaced by intelligent digital interfaces accessible via smartphone or computer. The rise of AI is banking also represent challenges. The rise of AI banking also represents challenges. Regulatory oversight had to adopt automatic decision making, ethical considerations around data usage, algorithm bias, and financial privacy become critical discussions. Bank, government, and technology providers had to collaborate to ensure that AI-driven financial system remained secure, fair, and transparent. This chapter illustrates how bank transition from traditional brick and mortar institution AI-powered fully digital financial platform. It highlights the interplay between technology, regulations, and customer behavior in shaping the future of banking. The era of physical money management was fading, replaced by instantaneous, automatic, and intelligent financial system. The next chapter will explore central bank digital currency and the global race to implement programmable money and development that will further accelerate the evolution of financial from 2026 to 2025. Central bank digital currencies, commonly referred to as CBDCs, are rapidly emerging, one of the most transformative innovations in global finance. Unlike traditional cash, CBDCs are digital representations of government-issued money, fully regulated and supported by the central banks of each country. They combine the stability of trust of traditional currency with the speed, efficiency, and programmability of modern digital system. By 2026, numerous countries had already begun pilots program for their digital currencies. China had rolled out the Sinai, Europe was testing the digital euro. The United States explored the digital dollar. India launched the digital rupee, and several Middle Eastern nations, including the UAE, introduced their own versions of CBDCs. Each of these systems allowed citizens and businesses to perform instant securely transactions without relying on physical cash or traditional banking intermediaries. The introductions of By 2026, numerous countries had already begun pilot progress for their digital currencies. China had rolled out the SNI. Europe was testing the digital euro. United States have explored the digital dollar. India launched the digital rupees, and several Middle Eastern nations, including the UAE, introduced their own versions of CBDCs. Each of these systems allowed citizens and business to perform instant, secure transactions without relying on physical cash and traditional banking intermediaries. The introductions of CBDCs has fundamentally changed how money flows within and across countries. Transactions that previously looked days involved multiple intermediaries and incurred high fees could now be completed in seconds with near zero cost. For businesses, this meant faster settlements, lower operational expenses, and more predictable cash flow. For individuals, it allowed intermediate peer-to-peer transfers, instant salary payments, and simplified access to government service. One of the most significant advantages of CBDCs is programmability. Government and financial institutions can embed rules directly into the currency, enabling automatic tax deductions, conditional payments, and even time-limited spending for specific purposes. For instance, welfare payments or subsidies could be delivered directly to recipients' digital wallet with strict rules on how they could be spent, ensuring transparency and reducing misuses. CBDCs has also accelerated financial inclusion on a global scale. People who previously lacked access to traditional banking systems now have the ability to hold digital money, make payments, and even participate in global markets. Rural areas and underbanked regions can now interact seamlessly with national and international economic, usually on a mobile device. Cross-border payment has become particularly efficient with CBDCs. In the past, remittances were slow, expensive, and often opaque. With digital currencies integrated into international framework, individuals can now send money across countries almost instantly. This has opened new opportunities for freelancers, remote workers, and businesses engaged in international trade. Countries that were previously excluded from first financial network are now fully connected to the global economic. Security is another critical advantage. CBDCs utilize advanced encryptions, blockchains verification, and real-time monitoring to prevent fraud and unauthorized access. Transactions are traceable and auditable, giving both government and users confidence in the integrity of the system, unlike cash, which can be stolen, lost, or counterfeited. Digital currencies after secure storage and direct accountability. Despite the numerous benefits, CBDCs also pose significant challenges. Privacy concern has become a major topic of discussion. Because transactions are fully traceable, there is potential for government surveillance or misuse of financial data. Policymakers must balance transparency, security, and individual privacy while ensuring that the system remains accessible and fair for all participants. Another challenge is global interoperability. Different countries are experimenting with different standard protocols and platforms for their digital currencies. Achieving seamless cross-border functionality requires international cooperation, shared technological standard, and regulatory alignment. By 2035, the countries that successfully implement interoperable CBDCs will dominate global digital finance. The rise of CBDCs has also promoted banks and financial institutions to rethink their roles. Traditional banks are now acting as service providers, offering digital wallets, integration tools, and support service for users of CBDCs. Their physical branches are no longer the center of financial activity. Instant Bank operate as digital platform embedded within the borderless ecosystem. Programmable money. By embedding programmability, security, and global connectivity, CBDCs represent more than just a retail displacement for cash. They symbolize evolution's money of itself from a physical, slow-moving medium to an intelligent, instantaneous, and globally integrated system. Citizen, business, and government must now navigate this new paradigm to remain competitive and financially empowered. This chapter lays a foundation for understanding how CBDCs will reshape the next decade of finance. They will serve as a backbone of AI-driven banking, smart contract, automatic lending, and tokenized assets, all of which we explore in the following chapter. The era of programmable money has become, and it will redefine how wealth is managed, transferred, and crowned across the world. Cryptocurrencies have emerged as one of the most disruptive forces in modern finance. While traditional money is controlled by government and central banks, cryptocurrencies operate on decentralized network independent of any single authority. They represent a shift in the perceptions of money itself, from physical and centrally issued to digital, decentralized, and programmable. By 2026, cryptocurrency have transitioned from niche investment to integral components of global financial system. Bitcoin, often referred to as a digital gold, remains to flagship's cryptocurrency. Its primary role has shifted from a security asset to a store of value. Much like gold, offering protection against inflation, economic uncertainty, investors, institutions, and even government are increasingly viewing Bitcoin as a hedge in an era of rapidly evolving digital economics. Unlike traditional assets, Bitcoin offers transparency, security, and resistance of concernsship, making it an attractive choice for individuals seeking to secure wealth outside conventional system. Ethereum and other smart contract platform has revolutionized how money can be used. These platforms go beyond currency, providing programmable environment where money, assets, and contracts interact automatically. Smart contracts allow businesses to automatic agreements, execute transactions instantly, and enforce rules without intermediaries. From tokenized from tokenizing real estate to creating decentralized marketplace, the applications are nearly limited. By 2026. Ethereum and similar platforms serves at the backbone of a digital economy that stretches across borders, the time zone, and industry. Stable coins, cryptocurrency pegged to fiat currencies, have become the preferred method for everyday transactions. They combine the stability of traditional money with the efficiency of digital network. For businesses and individuals, stablecoins reduce volatility, enable instant payment, allow seamless participation in the global economy. Countries experimenting with CBDCs often integrate stablecoins in their systems, creating hybrid ecosystem where fiat and crypto coexist harmoniously. Cross-border payment have seen some of the most dramatic improvements through crypto. Traditional remittance were slow, costly, and fraught with inefficiencies. Digital currencies, especially stablecoins and blockchain-based networks, allow near instantaneous transfers with minimum fees. Freelancers, multinations, businesses, and global merchants can now send and receive payments in seconds, making international commerce faster, cheaper, and more accessible than ever before. The integration of crypto with mainstream financial institutions is accelerating. Bank payment progress and financial platforms are beginning to offer cryptocurrency service, bringing the gap between traditional finance and decentralized network. Users can now hold crypto alongside fiat in digital wallets, spend crypto via cards, and even earn interest or decentralized finance platform. This coverage signal a future where cryptocurrencies are not just alternative assets but functional money for daily use. However, widespread adoptions come with challenges. Regulatory uncertainty remains a significant concern. Governments worldwide are still establishing rules for trading, transactions, and legal recognition of cryptocurrencies. Security and privacy issues are critical. As hacking and scam continues to pose risks for users and exchange, yet the market of rapidly developing robust custodial solution, decentralized platform, and AI-driven security system to protect participants. The evolution of cryptocurrency has also created new opportunity for innovation and wealth creation. Tokenized asset, decentralized finance application, and blockchain-based marketplace allow individuals to access previously attainable financial instrument. Artists, entrepreneurs, and small businesses can raise funds, sell digital assets, or create global marketplace without relying on traditional intermediaries. These democratizations of financial powers a new generation of participants of worldwide. By 2035, cryptocurrencies are expected to coexist with CBDCs and traditional banking system, forming a hybrid global economic is considered decentralized, and stable, serve as a unique purpose. Central banks maintain monetary stability. Cryptocurrency offer programmable and decentralized value, and stable coins facilitate everyday transactions. The combined ecosystem creates an unprecedented level of financial flexibility, inclusion, and efficiency. This chapter demonstrate how cryptocurrency have moved from circulating instrument to essential components of global finance. They offer freedom, innovations, and access while challenging traditional assumptions without money. About money, value, and financial control has the world moved further into the digital age. Cryptocurrencies will continue to play a pivotal role in shaping how money is used, transferred, and understood on a global scale. The next chapter will explore blockchain's payment and their impact on business, trade, and everyday transactions, further expanding the story of rapidly evolving financial system. Blockchain technology has emerged as one of the most significant innovations in modern finance, fundamentally transforming how money, contract, and transaction operate. Unlike traditional systems that rely on centralized authority, blockchains providers are decentralized, transparent, and immutable ledgers. By 2026, blockchain is no longer just a concept by cryptocurrency. It has become the backbone of our global payments, business transaction, and supply chain management. Business across the world are adopting blockchain payment to enhance space, security, efficiency. Traditional payments method, which often require days for cross-border transfers, intermediaries, and high transaction fees, are increasingly being replaced by blockchain-based network. Transactions now occur almost instantly with verifiable records that are accessible to all authorized parties. This transparency reduces the risk of fraud, double spending, and payment disputes, creating trust creating creating trust in an otherwise complex global economy. In addition to payments, blockchains enables programmable contract that automatically execute when certain conditions are met. These smart contracts are transforming industries ranging from real estate to insurance. For instance, a supplier can ship goods and the payments will be automatically released once the blockchain verifies delivery. This removes the need for manual oversight, reduces error, and accelerated business operations. Companies that integrate blockchains into their workflows gain a competitive edges in speed, efficiency, and cost reductions. Blockchains also open new opportunity for small businesses and freelancers. Previously, high fees and slow payments from bank limited international trade. Now, even a small freelancer in Indonesia or Africa can accept payments from a client in the United States within seconds at a fraction of the cost. Cross-border commerce with one relied heavily on complex intermediaries is now streamlined and accessible to anyone with an internet connections. The transparency provided by blockchain is critical for supply chain management. Every step of a product's journey, from raw materials to financial delivery, can be recorded on a blockchain ledgers. This creates trust among consumers, businesses, and regulators for industries such as food, pharmaceuticals, and electronics. Blockchains ensure authenticity, reduces counterfeit products, and provides real-time data for decision making. Financial institutions are integrating blockchains to modernize traditional system. Bank and payments processors use blockchain network to reconcile accounts, settle trades, and monitor transactions in real time. This reduces operational cost by enhancing accuracy. By 2026, many banks no longer require manual interventions for daily settlements, instead relying on automatic blockchain process to handle millions of transactions every day. The adoption of blockchain payment is also influencing government policy. Regulators are working to create framework that ensure security, prevent money laundering, and protect consumers while allowing innovations to flourish. Countries that successfully balance regulations and innovations are becoming global leaders in blockchain-driven finance. Cryptocurrency and stablecoins running on blockchain network further amplify these changes. Businesses can accept payment in digital currencies, instantly settle international invoices, and maintain financial transparency. For many, blockchain is no longer an experimental technology. It has become essential for competitive survival in the modern economic education and skill development has have also evolved around blockchain. Developers, financial analytics, and business leaders now need to understand decentralized network smart contracts and digital assets management. Companies that fail to integrate these key risks falling behind in an increasingly technology driven financial landscape. By 2035, blockchain is expected to underpin the majority of global business transactions. Its influence will extend far beyond cryptocurrencies, creating secure, efficient, and transparent financial ecosystem. It will enable program money, instant settlements, and fully trustable transactions, transforming the very concept of trust is commerce. This chapter demonstrate how blockchain payments are not just a technology innovation but a complete paradigm shift in business and trade. By removing intermediaries, reducing cost, and enhancing transparency, blockchain paves the way for a truly global, instantiated, and decentralized economy. The next chapter will explore AI-powered financial advisor and wealth management, showing how artificial intelligence will take control of money planning, investment, and the risk management by 2026 and beyond. Artificial intelligence has begun shaping every industry, and finance is no expectation. By 2026, AI-powered financial advisors are no longer prestigious concepts. They have become essential tools for managing wealth, investment, and risk. These intelligence systems combine advanced algorithms, real-time data analytics, and predictive modeling to deliver insight and recommendations that surpass traditional humans' capability. The impact on both individual investors and large financial institutions is profound. Traditional financial advice required personal meetings, lengthy paperwork, and sometimes a subjective judgment. Humans advisors, while knowledgeable, are limited by capacity, time, and human errors. AI advisor, on the other hand, can monitor hundreds of financial instruments, analyze global market trend instantly, and predict potential risks with unmatched speed and precision. Clients no longer need to wait for a scheduled appointment or shift through compliance reports. The AI advisor does all the heavy lifting, presenting clear recommendations tailored to each individual financial goals. For individual AI-driven platform offer automatic portfolio management based on personal risk tolerance, investment goals, and financial situation. AI system can allocate, assess, dynamically balances stock, bonds, cryptocurrency, and other instruments in real time. This level is automation ensure that portfolios are continuously optimized, reducing the likelihood of significant losses while maximizing returns. Even novice investors gain access to potential professional grades wealth management without the high fees traditionally charged by human advisors. In the corporate world, banks and investment firms deploy AI to monitor market and make data-driven decisions. Algorithm analyze millions of transactions, news, secure, and economic indicators, identify patterns that humans could easily miss. And regulatory compliance are handled automatically, allowing institutions to operate more efficiently and reduce operational costs. This AI integration not only improves decision making but also strengthens the resilience of financial system against volatility, the fraud. AI-driven advisors. AI advisors also excel at predictive analytics. They can forecast market trends, identify emerging investment opportunity, and warn for potential downturns before traditional systems detect them. This foresight allows both individuals and institutions to act proactively, reducing losses and capitalizing on profitable trends. By 2026, predictive AI has become a critical tool in shaping investment strategy and financial planning on a global scale. Another key advantage is personalization. AI advisors adopt user behavior, learning from each interactions, provide increasingly accurate and customized guidance. Whatever it planning for retirement, management, debt, or investing in a volatile market, AI tailors recommendations based on the individual lifestyle goals and risk appetite. This personalization extends to real-time adjustment in response to market fluctuations, new event, or personal financial changes. AI-driven wealth management also democratize access to sophisticated financial strategy. Previously, high net worth individuals were the primary beneficiaries of advanced investment tools and strategy. Today, anyone with an internet connection can access a powered platform, making professional-grade financial advice widely available. This democratization reduces inequalities in financial literacy and allows more people to participate efficiently in global markets. Security and privacy are critical considerations in AI wealth management. Platforms utilize crypto, multi-factor authentications, and secure data storage to protect sensitive financial information. Regulatory compliance is integrated into AI algorithms, ensuring that transaction advice meet legal and ethical standard. As AI continues to advance, continuous monitoring improvement maintain the balance between efficiency, security, and user trust. By 2035, AI financial advisors are expected to handle the majority of wealth management tasks globally. Human advisor will still play a role of strategy decision and client relations, but the bulk of data analysis, risk modeling, and investment optimization will be automatic. This transformation will redefine how individual institutions approach financial planning, moving from reactive to predictive and from generalized to fully personalized strategy. This chapter highlights the rise of intelligent wealth management, illustrating how AI advisors empower people and institutions to make smart financial decisions, assess global market, and optimize resources like never before. By combining speed, accuracy, and personalization, AI is not just assisting wealth management, it is redefining it entirely. The next chapter will examine tokenized assets and digital ownership, exploring how blockchain technology and digital tokens are creating new ways to invest, trade, and secure value in the digital age. Tokenization has emerged as one of the most transformative innovations in finance and investment by converting real-world assets into digital token. Real-world assets into digital tokens on a blockchain. Tokenization allows ownership to be a fractional, transparent, and easily transferable. From real estate and art to commodity in store, tokenized assets are redefining how people invest, trade, and secure value in the modern digital economy. Traditionally, investing in high value assets such as property, fine art, or rare collectibles require substantial capital, extensive paperwork, and intermediaries. Many individuals were excluded from this market due to high entry barriers. Tokenization removes these limitations. Assets can now be divided into thousands of digital tokens, allowing multiple investors to hold fractional ownership. This democratization of investment opportunities expand to access to market that were previously reserved for wealthy individuals and institutions. Blockchain technology ensures transparency and security in tokenized asset market. Each token represents a verifiable shares of the underlying assets recorded immutable on the blockchain. Ownership, transfer history, and transactions record are fully traceable, reducing the risk of fraud and disputes. Investors gain confidence knowing that their holding and verifiable, secure, and easily transferable cross-platform or border. Real estate is one of the most promising sectors for tokenization. Property that one requires significant investments and compliance legal procedures can now be fractionalized into tokens and offered to global investors. Rent, dividends, and capital gains can be distributed automatically through smart contracts, ensuring efficiency and transparency. Tokenized real estate open opportunity for small investors to participate in high value market, while property owners gains access to global liquidity without selling the entire assets. Art, collectibles, and intellectual property are also undergoing a digital transformation. Tokenizations allow artists, creators, and owners to sell fractions of their work, enabling a broader audience to invest in unique assets. Small contracts ensure that reassess profits and licensing rights automatically managed, reducing administrative complexity and guarantees their distributions. This create new revenue streams for creators, greater accessibility for investors. Financial markets benefits from tokenizations as well. Stock, bonds, and commodities can be digitized, enabling faster settlements, lower fees, and global SaaS. Investors can trade fractional shares across border instantly without relying on traditional exchanges. The efficiency and transparency offered by tokenized markets reduce intermediaries, streamline compliances, and improve liquidity, creating a more inclusive and dynamic investment environment. Tokenized Assessed also integrates seamlessly with digital wallets, decentralized finance, DeFi platforms, and AI-driven financial advisors. Investors can manage their portfolios, automate transactions, and assess real-time analytics with decentralized easy. This integration accelerates adoption, allowing individuals and institutions to participate in a fully digital global financial ecosystem. Regulatory framework evolving to accommodate tokenized assets. Government and financial authorities establish rules to ensure investor protections, transparency, and compliance while fostering innovations. Countries that develop clear guidelines are attractive new investment becoming hubs for tokenized assets market and blockchain based financial solutions. The implications of tokenization extend beyond finance. Ownership, property rights, and value transfer in the digital era are being managed. Individuals can now own digital representations of physical and intangible assets, trade them securely, and participate in the global market without geographic or a financial constraint. This transformation has the potential to redefine wealth distribution, financial inclusion, and economic participation the worldwide. By 2035, tokenized assets will be standard components of global investment portfolios, real estate, art, stock, commodities, and even intellectuals property will increasingly exist as digital tokens, allowing fractional ownership, instantaneous transfer, and automatic management. This shift empowers investor creators and business to engage in a transparent, efficient, and inclusive financial ecosystem. This chapter illustrates the revolutionary impact of tokenized assets, showing how blockchain and digital ownerships are transforming traditional investments models. As financial system evolve, tokenizations will play a central role in democratizing assets, increasing liquidity, and creating a truly global investment environment. The next chapter will explore DeFi, decentralized finance platform, and role there reshaping banking, lending, global financial assets, continuing our journey into the future of money from 2026 to 2035. Decentralized finance, commonly known as DeFi, represents a complete shift from traditional banking and financial system by using blockchains technology, smart contract, and decentralized network. DeFi removes intermediaries, giving individuals direct control over their assets, lending, borrowing, and trading. By 2026, DeFi platforms have become essential tools for millions of users globally, offering financial service without relying on conventional banks. Traditional banking relies heavily on intermediaries, banks, clearing houses, and brokers, which slow down transactions, add cost and restrict access. DeFi replace these intermediaries with programmable smart contracts, allowing anyone with the internet connections to participate. Borrowing, lending, trading, and yield generation are now automatic, transparent, and accessible 24/7 hours. This transformation is not just technological, it empowers financial inclusion on a scale never seen before. One of the most powerful applications of DeFi is peer-to-peer lending. Borrowers can access loans directly from lenders without banks or as middlemen. Smart contract automatically enforce repayment schedules, calculate interest, and manage collateral, reducing the risk of default. The system enables faster, more efficient credit access, especially for underbanked populations and small businesses that previously faced significant barriers to borrowing. DeFi platform also offer innovative saving investment opportunity. User can deploy their digital assets into liquidity pools or yield generating protocols, earning interest or reward automatically. AI-driven analytics integrated into DeFi platform optimize return, manage risk, and provide personalized strategy. Investors no longer need to rely solely on banks or financial advisors. Decentralized systems provide transparent and programmable tools for wealth growth. Global trade and payments benefit tremendously from DeFi. Cross-border transactions, which historically required multiple intermediaries and took days to settle, can now be completed within a minute or second. The system reduces fees, minimize errors, and enhance transparency. Small business, freelancers, and international clients can interact seamlessly without worrying about currency conversions, regulatory hurdles, or banking delays. Security and transparency are core advantages of DeFi. Blockchains record every transaction immutably, making it traceable and verifiable. Smart contracts automatically, if enforced, reducing human error and fraud risk while risks still exist, such as smart contracts vulnerabilities or platform exploits. The ecosystem is rapidly evolving with audit, insurance, AI monitoring, improving safety for users worldwide. DeFi also integrates with tokenized assets, digital wallets, and AI advisors, creating a fully interconnected financial ecosystem for user. For example, a user can collateralize tokenized real estate, borrow stablecoins, invest through AI optimized portfolios, and track all activity on a blockchain ledgers. This synergy between DeFi tokenization and AI powers unprecedented control, efficiency, and accessibility for both individual and institutions. By 2035, DeFi is expected to become the backbone of global finance. Many traditional banking services will be decentralized, automatic, and available globally in real time. Financial inclusions will reach billions of unbanked and underbanked individuals, empowering them to participate fully in the global economic. Wealth management, lending, payments, and investment will become accessible to anyone with digital assets. The rise of DeFi also challenges to the existing regulatory framework. Governments and financial authorities are working to balance innovations with consumer protection, transparency, and anti-money laundering policy. Countries that adopt clear and supported regulations are attracting massive innovation and global financial activity, positionally themselves as leaders in decentralized economy. This chapter illustrates how DeFi is not just an alternative to traditional banking, but a revolution that defines financial assets, efficiency, and empowerment by eliminating intermediaries, automating transactions, and integrating with AI tokenized assets. DeFi is creating a global financial system that is faster, more transparent, and universal accessible. The chapter will examine AI-driven trading platform algorithm markets and their impact on global investment strategy. Continues or explorations of the future of money from 2026 to 2035. Artificial intelligence has revolutionized global trading and investment, creating platforms that can analyze millions of data points, predict market movements, and execute traders in milliseconds. By 2026, AI-driven trading platforms are no longer experimental tools. They have become essential for institutions, investors, hedges funds, and even individual traders seems to maximize efficiency, minimize risks, and capitalize on opportunity across global market. Traditional trading relied heavily on human analysis, institutions, and manual executions. Even professional traders faced limitations in speed, scale, and accuracy. AI algorithms, however, can process vast quantities of historical and real-time data, detecting patterns that humans might miss. They evaluate microeconomic indicators, news events, social sentiment, corporate financial statement, and global trends, simultaneously providing insight that guide optimal trading decisions. One of the most significant advantages of AI-driven platform is speed. Trades can be executed in milliseconds, allowing investors to take advantage of even the smallest market fluctuations in high-frequency trading. This speed translate directly into profit making. AI critical tools for competitive financial market algorithm continuously monitor liquidity, volatility, and risk parameters, ensuring that traders are executed with precision and efficiency. Risk management is another area where AI excels. Traditional traders may struggle to react to sudden market shift or unforeseen events. AI platforms employ predictive modeling to anticipate potential downturns and market shocks. They can automatically adjust investment position, diversify portfolios, and hedge against losses. This proactive approach to risk has significantly reduced volatility for investors and improved overall portfolio performance. AI trading is not limited to traditional stock and bonds. Cryptocurrency market, tokenized asset, and DeFi platform also benefit from algorithm trading. AI can monitor decentralized exchanges, analyze liquidity flows, and predict price movement in highly volatile digital market. For investors, this integration offers new opportunity to profit while managing risk more effectively than ever before. Personalized AI advisor enhanced trading accessibility for individual investor users who receive tailored recommendations based on their risk tolerance, investment goals, and financial behavior. AI platform can manage reverse portfolios across multiple asset classes, executing trade automatically while providing real-time reporting analytics. This demo creates access to sophisticated investment strategies that were once reserved for institutional players. Global markets are increasingly interconnected through AI-driven platforms. Traders executing New York, London, Singapore, or Dubai influence each other instantly, creating a dynamic network of capital flows. AI system monitors these flows, identifying trends, arbitrate opportunity, and emerging sector investors who integrate AI into their strategy gain a global response. AI system monitors these flows, identifying trends, arbitrage opportunity, and emerging sectors. Investors who integrate AI into strategy gain a global perspectives, allowing them to impact faster and more accurately than those relying solely on human analysis. Regulations and oversight have evolved to accommodates air trading, government and financial authorities implement rules for transparency, algorithm accountability, and market fairness. Compliance features are embedded in AI system, ensuring that trades adhere to legal and ethical standards while minimizing the risk of manipulations or market abuse. The impact of AI-driven trading extends beyond profits. Markets become more efficient, liquidity improves, and pricing accuracy increases. In more investors gain confidence, institutions reduce operational risk, and capital allocations become more effective. These changes contribute to a more stable and resilient uh, financial ecosystem, even as the complexity and the speed of global markets continue to increase. By 2035, AI-driven trading platforms will dominate the financial landscape. Human traders will focus more on strategy, innovation, oversight, while AI manages the role of executions, monetary analysis. Global investments in strategy will become increasingly automatic, interconnected, and intelligent, allowing individuals and institutions to make informed decisions faster than ever before. This chapter demo demonstrates how AI-driven trading is reshaping global markets, transforming traditional investment practice, and providing unparalleled speed, accuracy, and efficiency. It highlights the convergence of technology in finance and global strategy, showing how artificial intelligence is not just assisting but redefining the future of investment. The next chapter will explore the integration of AI, blockchain, and tokenized assets, the building fully automated digital financial system, continuing our dive into the evolutions of money from 2026 to 2030. The financial world is undergoing a profound transformations where artificial intelligence, blockchain technology, and tokenized assets coverage to create fully automatic digital financial ecosystem. By 2026, this integration is no longer a theoretical concept. It is actively reshaping banking, investing, trading, and global commerce. This ecosystem combines speed, transparency, security, and automations, enabling participants to manage complex financial activities seamlessly. At the heart of these ecosystems is AI, which provides intelligent decisions making, predictive analysis, and automatic portfolios management. AI continuously monitors global financial market, consumer behavior, regulatory changes, and microeconomic trends. It uses this data to optimize trading strategy, allocate capital efficiently, and minimize risk. Human intervention is increasingly focused on oversight and strategy planning rather than routine financial management. Blockchain provides the backbone for trust and transparency. Every transaction's ownership record and smart contracts in is immutable, stored at a decentralized ledger. This ensures that all actions are verifiable, secure, and resistant to fraud. Small contracts automate compliance, payment, asset management, reducing administrative costs and accelerating business operation. The combinations of AI and blockchains ensure that financial ecosystems are not only efficient but also resilient against errors and malicious activity. Tokenized assets play a critical role in this ecosystem. Real world assets such as real estate, commodities, art, and intellectual property and represent a digital token. These tokens are fractionalized, making high value investment accessible to a broader population. Investor can buy, sell, or trade tokenized assets instantly while Smart contract ensures automated distributions of dividends and compliance. Tokenizations unlock liquidity in previously illiquid market and provide seamless integrations with AI-driven financial platforms. The integration of AI, blockchains, and tokenization allow for fully automatic financial flows. For example, individuals can deposit funds into a digital wallet, have a AI optimize their investments for developers, receive dividends from tokenized real estate, and automatically rebalance their assets based on market conditions. All of this occurs in real time without human interventions, creating a truly autonomous financial environment. These ecosystems are not limited to wealth management. Business profits from automatic supply chains, payments, cross-border transactions, are real-time financial reporting. Blockchains ensures transparency and traceability while AI optimizes liquidity, manages currency risk, and forecasts financial outcomes. Companies can reduce operation costs, mitigate risk, and respond dynamically to global market fluctuations. Financial inclusion is one of the most transformative effects of fully automatic ecosystem. Millions of unbanked and underbanked individuals have now have access to global financial services through smartphones and digital wallets. AI devices create them in investments. DeFi platforms provide access to loans and liquidity, and tokenized assets enable participation in high value markets. Geography and socioeconomic status no longer barriers to economic participation. Security and regulatory compliance remains critical considerations. This ecosystem incorporate multi-layered encryptions, decentralized verification, and real-time monitoring. Smart contracts enforce regulatory rules automatically while AI detects suspicious activity and potential for governments or regulatory bodies are adopting to this new landscape, creating framework that balance innovations, protection by transparency. By 2035, fully automated digital financial ecosystem will dominate global finance. Traditional banking, trading, investment parties practice will exist will this autonomous system, but the majority of financial activity will be managed by intelligence, blockchain, secure and organized platforms. Wealth creation, payment processing, lending, and global commerce will be faster, more efficient, and accessible to a wider population than even before. This chapter demonstrates how the convergence of AI, blockchains, and tokenized assets is not just improving financial system but transforming them entirely. This ecosystem provides unprecedented efficiency, transparency, accessibility, enabling individuals and businesses to interact with global finance in ways that were previously unimaginable. The next chapter will explore the future of cross-border payments and global remittance, analyzes how technology, cryptocurrency, and AI are making international money transfers faster, cheaper, and more exclusive. Cross-border payments and global remittance have historically been slow, costly, and complex. Traditional systems rely on banks, intermediaries, and clearinghouse, often taking days to settle transactions and charging high fees. By 2026, technology is transforming the way money moves across borders, creating faster, cheaper, and more exclusive solutions that impact millions of individuals, businesses, and global markets. Cryptocurrencies and stablecoins play a pivotal role in this transformation. Like traditional fiat-based system, digital currencies enable near instant transfer between any two points in the world. Transactions that previously took several days and incurred 5 to 10% fees can now be completed within seconds at minimal cost. This efficiency is particularly valuable for overseas workers sending remittance to family members in developing countries. Small business engage in international trades and freelancers receiving global payments. Decentralized finance platforms DeFi further enhance cross-border payment system by leveraging smart contracts. Blockchains network DeFi eliminates the need for intermediaries, automates settlements, and ensures transparency. User can send, receive, and even invest funds globally without relying on bank. This democratization democratization of financial services allows individuals in previously unbanked regions to participate in international commerce and benefit from real-time transactions. Central bank digital currencies (CBDCs) are also reshaping global remittance. Governments are experimenting with the direct digital transfers that bypass traditional banking channels. For example, a worker in Indonesia can send digital rupees or stablecoins to family members in Pakistan, and the funds are instantly available in their digital wallets. CBDCs provides security, regulatory oversight, and traceability, addressing concerns associated with the pure cryptocurrency transfer while maintaining speed and efficiency. AI-driven platforms optimize remittance by providing real-time currency conversion, fee minimizations, and predictive analytics. These platforms analyze global exchange rates, volume, and historical patterns to recommend the most efficient routes for international transfers. User benefit from lower cost, fast delivery, and reliable service, while financial institutions gain operational efficiency. The impact of improved cross-border payment is enormous. Overseas workers can send money home without losing a significant portions to fees, boosting household income and local economics. Small and medium-sized business can engage international trade without delays, improving cash flow and competi- competitiveness. Global freelancers and remote workers now receive payment instantly, enabling smoother financial planning and operational flexibility. Blockchain technology ensures transparency and security in cross-border transactions. E-transfer is recorded imputably, making it inauditable and verified. Fraud risk is significantly reduced, and despite overpayment are minimized. This transparency fosters trust among users, business, and regulators, paving the way for broader adoption of digital payment systems worldwide. The evolutions of cross-border payments also support financial inclusions. Millions of individuals without traditional banking access can now participate in global finance using mobile devices, digital wallets, and blockchains enable platform. AI advisors guide them managing funds, optimizing transactions, and investing in accessible assets. This transformation bridge the gap between developed and developing economies, creating a more connected global financial system. Regulatory framework are adopting to these changes. Governments are collaborating internationally to ensure compliances, prevent money laundering, and protect users while still encouraging innovation. The balance between security and speed and accessibility is essential for success of digital remittance and cross-border payment. By 2035, cross-border payments and global remittance will be instantaneous, low-cost, and universal accessible cryptocurrency, stablecoin, CBDCs, DeFi platforms, and AI-driven solutions work together to create a seamless global financial network. This transformation empowers individuals, both business and strengthens global economic integration. This chapter illustrates how the future of cross-border payment is not only faster and cheaper, but also more inclusive, transparent, and secure. By combining blockchain, AI-driven, AI, digital currencies, and its decentralized systems, international money transfer is being redefined, providing unprecedented opportunity for millions around the world. The next chapter will explore the impact of AI and digital finance on personal wealth and retirement planning, showing how individuals can leverage this technology to optimize their financial future. Personal wealth and retirement planning have traditionally relied on humans, advisor, fixed investment strategy, and manual tracking of saving. By 2026, artificial intelligence and digital finance are revolutionizing this process, allowing individuals to manage, grow, and optimize their wealth with precision efficiency that was previously unimaginable. AI-driven platforms are enabling personalized, dynamic, and automatic financial planning tailored to each person's goals, risk appetite, and life circumstances. AI-powered wealth management system analyzed vast amounts of data, including income, expenses, market trading, economic forecast, and global financial indicators. Using this data, the AI predict future financial outcomes, designs optimal investment strategy, and continuously adjust portfolios to meet long-term objective for retirement planning. This means Individuals can maximize saving, minimize risk, and ensure sustainable income streams throughout their later years. One of the key advantages of AI personal finance is personalizations. Unlike traditional one-size-fits-all strategy, AI tailors recommendations for each user. Example: a young professional may receive guidance to invest aggressively in growth stock, cryptocurrency, or tokenized assets, while a middle-aged investor may focus on stable income-generating assets and risk mitigations. The system dynamically adjusts allocations as market conditions or personal circumstances changes change, keeping financial goals on track. Retail finance platforms integrate multiple investment options seamlessly. Users can manage traditional stock, bonds, ETFs, cryptocurrencies, tokenized real estate, and FI products within a single ecosystem. AI monitors these assets, reallocates funds where necessary, and predict market trends to maximize returns. Automations eliminate human errors and ensure that investment strategies are continuously optimized without manual interventions. Retirement planning is particularly enhanced by AI by modeling projected expenses, inflation, and life expectancy. AI can create personalized saving schedules, investment paths that minimize risks and maximize growth. It also considers tax efficiency, global investments, opportunity, and risk diversification, enabling enabling individuals to maintain or even improve their standard of living thereafter retirement. Smart contracts can automate contributions with withdrawals and rebalancing, ensuring financial security without constant monitoring. Financial influence benefits greatly from this technology. Individuals without access to traditional wealth advisors can now use a driven platform to plan, invest, and manage money efficiency. Even in developing countries or underbanked regions, people can access global market, optimize their saving, and participate in investment opportunities that were previously unavailable. Security and transparency are central to a power personal finance platforms are advanced encryptions, blockchain verification, secure authentications to protect sensitive data. Users gain confidence knowing that their financial plans, investment, and transactions are both private and secure. Additionally, AI can detect potential fraud or anomalies in real time, protecting personal wealth for cyber threats or unauthorized activity. The integrations of AI with blockchains and tokenized assets enhance financial planning. Further, individuals can invest in digital assets, automate dividends collections, and even participate in fractional ownership of high-value assets globally. AI ensures that portfolios remain balanced, compliant, and optimized for long-term growth, while blockchains guarantees transparency and verifiable ownership. By 2035, AI and digital finance will be central to personal wealth management and retirement planning. Human advisor will still provide guidance on complex decisions, but the bulk of portfolio management, risk assessment, and financial optimization will be automatic. Individuals will have the tools to manage wealth proactively, respond to global market change, and secure the financial future with minimal manual effort. The chapter illustrates how AI and digital finance are transforming personal wealth management and retirement planning by combining automations, personalization, predictive analytics, and global access. Individuals can optimize their finance, achieving their long-term goals, and participate fully in the digital economy. The traditional approach to retirement and wealth creation involving a dynamic, intelligent, and automatic system empowering people worldwide to secure their financial future. The next chapter will explore the role of AI global finance series and risk management, showing how predictive technology can prevent to mitigate economic disaster in the coming decade. The global financial system has always been vulnerable to crises, from banking collapse to market crashes and geopolitical events. Unforeseen risk can destabilize economic and affect millions of people. By 2026, artificial intelligence has become a powerful tool in predicting, managing, and mitigating these financial risks. AI is reshaping how government institutions and investors anticipate crises and respond actively in real time. Traditional financial risk management relied heavily on historical data, human judgment, and reactive measures. Decision makers often struggled to identify emerging threats or acted too late to prevent losses. AI power can analyze vast amounts of real-time data from multiple sources, including economic indicators, market trends, social sentiments, and geopolitical events. By continuously monitoring these variables, AI system can detect anomalies, predict potential crises, and suggest preventive actions before the situations escalates. One major application of AI in risk management is predictive analytics. Machine learning models can simulate various economic scenarios and forecast their impact on markets, currencies, and assets. These predictions enable government and institutions to implement, prevent, or policies just interest rates or intervenue in financial market proactively. Predictive AI reduces standing, enhances preparedness, increasing the stability of financial system globally. AI also improves the resilience of financial institutions. Bank and investment firm can use AI to monitor liquidity, assess credit risk, and detect fraudulent activities in real time. For example, if a sudden spike in defaults or market volatility is detected, AI algorithm can automatically recommend corrective measures such as reactive assess or hedging. Explore this proactive risk management minimize losses and ensures continuity during turbulent times. Cross-border financial risks such as the currency fluctuations, trade disruptions, and global market shocks are particularly complex. A system can monitor international events and integrate multiple data sets to identify systemic risk. Government and multinational corporations uses these insights to prepare contingency plans, stabilize market, and maintain investor confidence by predictive ripple effect before they spread. AI prevent localized problems from escalating into global crisis. DeFi platforms, blockchains, network, and tokenized assets also benefit from AI-driven management algorithms, monitor transactions flow, liquidity flows, and smart contracts to detect irregular activity, potential hacks, or market manipulation. This integration provides transparency, security, and automated safeguards, ensuring that digital financial ecosystem remain robust even in volatile conditions. AI-driven stress testing in other critical innovations, regulators, and institutions can simulate extreme market scenarios such as economic recessions, interest rate shocks, or geopolitical conflict. AI evaluates the impact of these scenarios on portfolios, banks, and entire economics, providing actionable insights. Stress testing ensures that both private and public institutions are better prepared for unexpected shock. Global financial crises are often exacerbated by human error, delayed reactions, or lack of coordination. So AI mitigates these vulnerabilities by providing accurate real-time insight, automating response, and enabling collaborations across borders. Governors and central banks and financial institutions can coordinate policies based on shared AI-driven analysis, creating a more resilient and interconnected global economic. Ethical and regulatory considerations are essential when deploying AI is crisis management. Algorithms must be transparent, unbiased, and accountable. Regulators are developing framework to ensure that AI-driven decisions are monitoring, explainable, and aligned with public interest. Proper governance balance innovations with safety, ensuring that AI supports stability rather than introducing new risk. By 2035, AI will play a central role in global financial risk management. Predictive analytics, automated monitoring, and intelligent decision making will allow institutions to anticipate crises, respond efficiently, and maintain market stability. AI will act as a global safeguard, reducing the likelihood of catastrophic financial events and enhancing resilience across all of levels of economic. The chapter demonstrates how artificial intelligence is transforming the approach to financial crisis and risk management by leveraging real-time data, predictive modeling, and automatic response. AI powers government, institutions, and investors to make informed proactive decisions. The future of financial stability increasingly relies on intelligent systems that can detect, analyze, mitigate risk faster than even before. The next chapter will explore AI and blockchain is global trade optimizations for skin or supply chains, transaction efficiency of the automations of international commerce. Global trade has always been the backbone of economic growth, connecting countries, businesses, and consumers. However, traditional trade system has faced numerous challenges: slow documentation process, inefficient logistics, delayed payment, and high operational costs. By 2026, artificial intelligence and blockchain technology are revolutionizing global trade, creating more efficient, transparent, and automated ecosystem that benefit business and economic worldwide. Blockchain provides an immutable, decentralized ledger for trade, transactions, ensuring transparency, traceability, and accountability at every step. Smart contracts automate agreement payments and compliance check. For instance, a shipment of goods can trigger automated payment once delivery is verified, or blockchains reducing delays on eliminating the need of intermediaries. This ensures faster settlement, lower cost, and greater trust among trading partners. Artificial intelligence enhances this blockchain system by analyzing vast data sets for logistics, market trends, and financial markets. AI predicts supply chains disruptions, optimizes routes, and identifies cost-saving opportunities. In real time, companies can adjust operations proactively to avoiding delays due to weather, geopolitical events, or market fluctuations. AI predictive capabilities also help in demands forecasting, inventory management, and risk assessment, making global trade more resilient. Tokenization play a critical role in trade financing. High value goods, commodities, or invoices can be represented as digital tokens, enabling fractional investments and financing liquidity for exporters and importers. Tokenized access to allow faster access to capital, reduced dependency on traditional banking, and streamlined cash flow. Combined with AI-driven credit evolutions, businesses can obtain funding almost instantly, reducing bottleneck in global trade. Cross-border payments have been transferred through AI and blockchains. International settlements that previously took days can now occur within minutes. Stablecoin and digital currencies facilitate seamless currency conservation, minimize fees, and reduce exposure to exchange rate volatility. This efficiency powers business of all sizes to operate globally with ease while ensuring transparency and compliance with regulatory requirements. The integration of AI and blockchains also improves sustainability in global trade. AI algorithms optimize transformation routes, reduce energy consumption, and minimize carbon footprints. Blockchains verifies ethical sourcing for fair trade practice and compliances with environmental regulations. The combination ensures that trade is not only efficient but also responsible, aligning with the growing global emphasis on sustainable business practices. Small and medium-sized enterprises (SMEs) benefits immensely from these technologies, previously excluded from complex international trade network due to cost documentations or lack of access. SMEs can now participate in global commerce. Automatic smart contract, instant payment, and AI automized logistics allow smaller players to compete on a global scale, democratizing international trade opportunity. By 2035, AI and blockchains will underpin almost every aspect of global trade. Supply chains will be fully automated, payments instantaneous, and financial settlements transparent. Business will operate more efficiently, risk will be minimized, and economic growth will be enhanced. The integration of intelligence system and decentralized technology will redefine how goods, service, and capital move across borders, creating a truly interconnected global economy. This chapter highlighted how AI and blockchains are optimizing global trade, making it faster, more transparent, and more accessible than ever. By combining automation, predictive intelligence, decentralized ledgers, business are economic and empowered to thrive in a complex, rapidly evolving market environment. And that's a wrap. This concludes our series of the future of money from 2026 to 2035. Don't forget to subscribe to XRax School for more insights, update, and professional analysis in finance, technology, and the global economic. Thanks for watching and see you in the next video. Thanks. Hi everyone, welcome back to your channel. Today we are diving deep into one of the biggest question people keep asking over and over again. Do Facebook, TikTok and Instagram really pay dollars in 2026? Is social media still profitable? Can a normal person without fame, without a big team, without expensive gear actually earn money from social platforms in today's world? These questions confuses millions of people. Some say social media is dead, some say earning are down, some say TikTok stop paying, some say Instagram stop paying, some say Facebook is cutting monetization, and some people claim they are earning thousands of dollars per month. So what is the truth? Today in this full research based breakdown, I will explain everything clearly, simply, and honestly. So you finally understand how the creator economy works in 2026. We are going to explore the real earning system, what changed from the last few years, how the algorithm behaves now, and which countries actually get higher payout. We will also talk about USA as Indonesia earning potentials, the new monetization updates, the rise of social commerce, and real life earning models that creators use today. So grab your seat because this is not just a short talk, this is a full deep explanation that covers every corner of social media earning in 2026. Let's start from the beginning. Social media has changed dramatically over the last few years. In 2021 and 2022, the creator economy exploded. TikTok introduced rewards, Instagram introduced bonuses, Facebook's Reels started paying heavy, and YouTube Shorts became monetized. People were getting easy reach, high views, and fast growth. But then slowly everything began to shape. More creators entered the platform, competitions increased, algorithm changed, bonus programs were reduced, and platform realized something major. Short form videos bring views, but they don't bring strong revenue. So major companies changed their strategies. Instead of only paying creators for views, the platform started focusing on commerce, brand deals, subscriptions, affiliate programs, and long form video ads. This is the foundation of social media earning in 2026. Let's break down platform by platform. Let's start with Instagram. Instagram in 2026 is not the Instagram 2021. Back then, creators used to earn from real bonuses and short content rewards, but Instagram quietly removed most bonus program. In many countries, they post creators to build real businesses. Instagram does not pay creators for normal reels views. Instead, creators earn through brand deals, subscriptions, badges in live collaborations, Instagram shops, affiliate links, digital product selling. Brand deals are number one, and the reason is simple. Instagram has the strongest influence in market. Brands pay creators for product promotion, short reviews, fashions, lookbooks, makeup tutorials, lifestyles, showcases, story integrations, reel-based comparison. Even small impressions with 5k to 10k followers make money if they have good engagement. A huge shift happened before creators relied on the platform to pay them. Now Instagram encourages creators to earn from their audience directly or through brands. This creates more stable income. Instagram shop and affiliate commissions are also massive right now. Influencers can earn every time a product sells through their links. So yes, Instagram pays, but not directly from views. It pays through business strategy. Let's move to TikTok. TikTok is the fastest platform on earth. It can make someone from zero to millions of views in a single day. But TikTok's direct and revenue has always been small compared to other platforms. So in the 2026, TikTok made a major change, but they built world's strongest social commerce system, TikTok Shop. Today, TikTok Shop is the biggest money making machine for creators. People make money from affiliate products, videos, linking products in short periods, commissions per sale, pay product promotion, live streaming with product sales, brand collaborations, creator marketplace deals, digital product selling. The earning is not based on views, it is based on sales. A creator may get 10,000 views and still make $200 if the product will sell. A creator may get 1 million views and earn nothing if nobody buys. This system rewards creators who can influence buying decisions. Creators in Indonesia and USA earn massive commissions from TikTok Shop because the audience in the both countries buy a lot live gifts, brand deals, affiliate sales, creator reward programs. So yes, TikTok pays, but the money comes from commerce, not just views. Now let's talk about Facebook. Facebook is still one of the highest paying platform for long videos in 2026. Long videos are the main money makers. Facebook paying through in-stream ads, stars, paid subscriptions, real bonusing, limited countries, transporters, brand collaborations. Facebook group monetized with membership, product selling through Facebook Shop. Facebook love long videos because advertisers pay more for long form content. This is why creators who upload 3 to 4 minutes videos or 5 to 10 minute videos earn well. Short video reels are good for reach, long videos are good for earning. Facebook has strict rules now. No reused content, no TikTok watermark, no copyright, no fake eye faces, no misleading content, no repetitive low quantity clips. Original content earns reused content loses monetization, but for creators who produce their own videos, Facebook remains powerful. Now let's talk about the earning differences by country. This is very important. In countries like USA and ad rate are extremely high. Brand pay more, CPM is higher, affiliate commission is higher, viewers buy more from social media shops. A creator in the USA can earn 5x more than a creator in a low income country for the same number of views. This is why creators target USA based audience through motivations videos, tech reviews, business content, finance tips, life hacks, online earning tutorials, trending challenges, storytelling content, self improvement content. US audience pay well, watches longer, and convert into buyers. Now let's talk about Indonesia. Indonesia has one of the biggest TikTok user bases in the world. TikTok shop is booming. People buy every day. Even small creators get millions of views. Affiliate sales are huge. Conversion rate is higher. So even though Indonesian CPM is lower than USA. Their sales numbers are much higher. Creators earn through volume. So USA high rates per view, Indonesia high sales volume. Both are very profitable in their own way. Let's talk about real earning level today. Small creators with under 10,000 followers can earn $50 to $300 per month. Creators with 10k to 100k followers can earn $500 to $3,000 per month. Mid-level creators with 100k to 500k followers earn $3,000 to $20,000 per month depending on niche. Large creators unlimited amounts based on brand shop sales. Courses, affiliate income, ads, live stream partnership. The truth is simple. You don't need millions of followers to make money. You need engagement, trust, constancy, strategy, niche focus, value-based content monetization funnel. Let's understand the creator strategy for 2026. Step 1 of the choosing an niche. This is extremely important. When you talk about everything, the algorithm gets confused. When you talk about one topic repeatedly, the algorithm pushes your content to the right audience. Strong niche include tech, money, business, finance, fitness, beauty, motivations, educations, cooking, lifestyle, comedy, gaming, crypto, self-improvements, and travel. Choose one and stick within it. Step 2 is posting short form videos. Really short videos give reach. Short videos bring attention. Short video build your base. Short videos are the engine. But short videos alone do not make money. You need long form videos, affiliate links, the product to convert views into income. Step 3 is building trust. People buy from creators who provide value. If your content helps the viewer, they trust you. Trust is equal to income. Step 4 is using multiple income streams. Never depend on one source. Platform change rules every year, but your influence remains. Let's talk about the dark side briefly. Many creators quit because view drops, algorithm changes, earning fluctuate. Platforms reduce bonuses, contact gets rejected, monetization gets disabled, people lose motivations, and competition increases. Yeah, but the people who succeed are not the ones with viral video. They are the ones who show up daily, consistently with valuable content and the clear niche. If you treat content creation like a business, it pays like a business. If you treat it like a hobby, it pays like a hobby or not at all. Success requires patience, constancy, learning, experimentations, quality, audience connections, and dedication. This is a truth that nobody talk about. Let's take a real example. A small creators makes really short video reviewing small gadgets. Each videos get 20k to 50k views. They promote the product all through TikTok, Shop, Amazon, affiliate. Even if only a small percentage, why the creators earn from commissions. One side might make $10, another might make $50. Some might make $200. Some might go viral and make thousands. This is how creators earn stable money, not from views but system via content. Another example of a creator in the fitness niche uploads long videos on Facebook. Each video earned from in-stream ads. Each moderate views give good money. A third example, in Instagram creator focuses on beauty and makeup brands for her for product viewers. She earns from affiliate links. She earns from subscriptions. She earns from story promotion. This is the modern creator model. So yes, the answer is two main questions. Do Facebook, TikTok, and Instagram pay money in dollars to 2026? Yes, absolutely, but not the way people expect. Facebook pays stronger for long video. TikTok pays stronger for short Instagram page strongest through brand deals and subscription. If you want to earn, you must use multiple income streams, short videos, long video, affiliate links, brand deals, social commerce, live streams, digital products, subscription. This is the complete blueprint. Thank you for watching the full breakdown. If you enjoyed this deep research based on content, make sure to like, share, and subscribe. More powerful content coming soon, produced by XRax School. Thanks. Hi everyone, welcome back to XRax channel. XRax School. Today we are talking about one of the biggest financial shift happening in the corporate world. Companies around the globe are now adding cryptocurrencies like Bitcoin and Ethereum directly into their treasury reserves. This strategy is known as crypto corporate treasury, and it is reshaping how modern businesses think about cash inflations, liquidity, and long term financial security. Over the past few years, the traditional companies have relied on bank deposits, government bonds, and cash reserves to protect their balance sheet. But as this inflation rises, interest rates fluctuate, and global financial uncertainty increases, many corporations are exploring alternative assets. And crypto, especially Bitcoin, has become one of the most attractive options. So, what is exactly crypto corporate treasury? In simple words, it means that a business holds part of its financial reserves in digital assets instead of keeping everything in cash. Some companies are buying cryptos as a hedges against inflation. Others are buying it to diversify their treasury and reduce reliance on traditional banking system. And some are using crypto in position themselves as modern tech-forward organizations that believe in the future of decentralized finance. One of the biggest reasons behind this shift in the performance of Bitcoin over the last decade, despite high volatility, Bitcoin has constantly outperformed most traditional assets in the long term. Many corporate leaders believe that holding a small percentage of Bitcoin can significantly strengthen their balance sheet over time. This thinking becomes mainstream after high profile companies started adopting crypto. One of the earliest and most famous examples in the MicroStrategy, whose CEOs turned the company into the world's largest corporate holder of Bitcoin. This strategy influenced hundreds of other businesses to exploit crypto as a treasury assets. But it's not only tech companies doing this, even manufacturing businesses, retail, brand service companies, and some financial institutions are exploring crypto treasury strategies. The idea is simple. Instead of letting money lose value due to inflation, diversify into digital assets that have high growth potential. Some companies are even accepting payment in crypto and keeps those payments on their books as a part of their long-term research. Now let's talk about why corporations are attracted to crypto treasury models. First, crypto is global and operates 24/7 hours, meaning companies are not restricted by banking hours, international transfer delays. Second, cryptocurrencies provide transparency and portable ownership through blockchain technology. Third, the liquidity of top cryptocurrency mean companies can convert digital assets back into cash almost instantly if needed. Another major reason is inflation. Many CEO worries that keeping too much cash on their balance sheet produces purchasing power on time. So instead of relying on traditional saving instruments, companies are shifting a small percentage of their assets in cryptos to create a long-term store of value. This trend also grown to increase institutional adoption. Today, more hedge funds, asset managers, and even pensions funds are exploring digital assets, which gives companies more confidence to add crypto to their treasury strategy. However, crypto corporate treasury is not without risk. The biggest challenge is price volatility. This value of crypto can rise rapidly, but it can also sharply fall. That's why companies must follow strict risk management strategy and also allocate a portion of their treasury instead of going all in. Another challenge is regulatory uncertainty. Different countries have different tax rules and compliance requirements, meaning corporations must work closely with financial advisors before adding crypto to their balance sheet. Security is another major concern. Companies holding large amount of digital asset must use secure custody solution, multi-signatures, wallets, and institutional grade protection to avoid hacking or theft. Many corporations now partner with professional crypto custodians which specialize in storing large-scale digital assets securely. Despite these challenges, the trend continues to grow. Every year, more corporations announce that they are adding Bitcoin or Ethereum to their treasury. The global financial landscape is changing, and companies want to stay ahead. Holding crypto is no longer seen as gamble. It's becoming a forward-thinking financial strategy designed for long-term growth, protections against inflation, and global liquidity. As the blockchain technology continues to evolve, corporations will likely integrate even more digital assets into their financial planning with our tokenized real-world assets, stablecoins, or cross-border payments, or decentralized finance tools for yield generation. The corporate treasury of the future is going to look very different from what we see today. This is beginning of a new era where companies don't just rely on traditional banks; they build hybrid models combining cash, bonds, and digital assets. Crypto corporate treasury shaping a financial world of tomorrow, and the business that adopt early will have massive advantage in this year ahead. Thanks for watching, and if you find this video helpful, make sure to like, share, and subscribe to XRax School for more financial and crypto based research content. Thanks. Hey everyone, welcome back to your channel. Today we are diving into one of the most exciting developments in the crypto world, the USDT chains war in 2025. Tron, Ton, and Solana are all competing to become the top network for USDT transactions. This competition is reshaping the future of stablecoins and blockchain payments worldwide. USDT and Tether is the most widely used stablecoin in the world if pegged to the US dollar and is used for trading, remittance, and DeFi and payments. But over the past few years, the choice of which blockchains to use for the USD T has become extremely important. This is because transaction speeds, fees, security, and adoption all depends on the underlying chain. Tron network. Tron has been the traditional leader for the USDT transaction. It offers fast speeds and low fees, which made it extremely popular for traders and exchanges. Millions of USDT transactions still happen on top every day. But Tron faces competition from newer, faster, and more scalable networks. Ton blockchains Ton or the open network is rapidly growing in popularity. It was originally created by the team behind Telegram, has a strong community in Asia and Europe. Ton offers lightning fast transaction, almost zero fees, and excellent scalabilities. Many exchange and payment apps are now integrating USDT on Ton. Experts predict that Ton could capture a large portion of cross-border payments because of its efficiency and adoption by messaging apps. Solana is another powerhouse. Is a USDT chains were known for extremely high-speed network and low fees. Solana can handle tens of thousands of transactions per second. This makes it ideal for high-frequency trading, DeFi applications, and a large-scale payment system. More and more USDT liquidity is moving to Solana because users want speed and most efficiency. Why this matters? The chain choice affect anyone: traders, exchanges, business, and individual users. Speed: faster chains like Tron and Solana allow instant transactions. Fees: lower fees mean cheaper transfer, especially for cross-border payment. Security: each chain has its own protocol and users need reliability. Adoption: exchanges and apps decide which chain to integrate needs based on user demands and transaction value. For example, if you want to send USDT for Asia to Europe quickly, Tron may take a few seconds with minimum fees, but Tron or Solana could do it easier and cheaper depending on network's congestion. This affects traders, business, even remittance service. Current trend in 2025, Tron still dominate traditional exchanges and long-term USDT holders. Tron is growing fast in Asia and Europe, especially its messaging app and remittance-focused platform. Solana is gaining massive adoption in DeFi and high-speed trading applications. This battle is not just technical, it's about community partnership and integration. The exchange and payments platform are choosing chains that give them the most advantage in speed, cost, and user trust. What this means for user now have more options to move USDT quickly and cheaply. Business are choose which chain suit their payments needs. Traders need to be aware of chain specific liquidity and transaction fees. Border Cross-border payments are becoming faster, cheaper, and more accessible. Future predictions: by the end of 2025, Trump will still have its loyal user but may lose ground to done in messaging app payments. Trump could become the preferred choice for global remittances and micro transactions. Solana will dominate high-speed, high-volume trading and DeFi system. The real winner. User benefit from faster transactions, lower cost, and better options. The competition between chains push innovation, scalability, and operation to new height. Conclusion: the USD-China war is not just about technology; it's about adoptions, efficiency, and usability. Tron, Ton, and Solana are all laying for dominance in 2025, and the result will shape the future of stablecoin payments worldwide. Whether you are a trader, a business owner, or just a crypto user, understanding these changes are critical for making the right decision. The biggest takeaway: more competition means better service, lower fees, or faster transaction for everyone. We are witnessing a new era in stablecoin usage, and the battle between of Tron, Tron and Solana is at the center of it. If you enjoyed this video, don't forget to like, subscribe, and share it with friends. This is your channel XRax School, bringing your latest update in crypto, blockchain, and digital finance. Thanks for watching, and I will see you in the next video. Thanks. Hi everyone, welcome back to your XRax channel. Today we are diving into one of the most important and sensitive topics in the entire crypto world: regulations, compliance, and financial crime. As the crypto industry keeps growing, government and global organizations and financial watchdogs are all tightening oversight. And understanding their landscape is crucial for anyone involved in digital assets, trading, DeFi, and blockchain finance. Over the past few years, crypto has moved from an experimental technology to a real financial system used by millions of people and thousands of companies. But with massive growth comes a massive responsibility, especially when it comes to preventing illegal activity from money laundering and fraud to terrorist financial and tax evasion regulations. Regulators are now treating crypto as a serious financial sector that needs serious rules. One of the biggest reason regulations has become such a major global issue is the increasing use of digital assets on international platforms. Criminal organizations have realized that blockchain transactions can move across borders quickly without traditional banking friction. This has pushed global regulators like the FATF and the US, the Treasury and European Union, and tribal Asian government to implement stricter framework for monitoring crypto activity. These frameworks are designed to make crypto safer, more transparent, and more aligned with the global financial system. Financial crimes crypto usually appears in a few major forms. The first is money laundering, where criminals try to hide the source of illegally earned funds by passing them through exchanges for mixture. Another common form is fraud or scam, rug pulls, fake projects, phishing attacks, and Ponzi schemes that tricks users into sending their funds. Then there is illicit cross-border financial, where digital wallets are used to send money globally without traditional controls. Each of these activities weaken trust in crypto and give regulators more reason to intervene aggressively. Regulators around the world are now introducing new rules that require exchange, DeFi platform, and even blockchains developers to follow strict compliance producers. This includes KYC, Know Your Customer, KYB, Know Your Business, mandatory registration, transaction monitoring, and reporting of suspicious activity. In many countries, crypto service providers must behave like traditional financial institutions and follow the same legal traders as banks. This means more transparency, more audit, the stronger security protocols. However, regulation is not just about restrictions, it also creates opportunity. When a financial sector becomes regulated, it becomes more legitimate. Big institutions and corporations are more willing to invest. Banks start integrating blockchain tools. ETFs and regulated crypto products enter the market, and users gain more trust because they know the system has safeguards. This is why many experts believe that the next phase of crypto adoption will come after the regulatory framework are fully established. A very important development is the rising demand for compliance technology, also called tech. Companies are also using AI, machines learning, blockchain analytics to detect suspicious behavior in real time. These tools can track wallet activity, identify unusual patterns, trace stolen funds, and even map complex money laundering networks. Instead of ignoring compliance, new generation crypto companies are now building it directly into their system because they know this is the only way to survive long term. Global governments are also working together more than ever before. Cross-border collaborations are being formed to track illegal transactions and share intelligence. The EU has passed the MiCA regulation. The US is pushing for strict national laws. The UAE and Singapore are designing advanced compliance framework, and even developing economies are setting up cryptocurrency units. The entire world is moving toward a harmonized approach to digital assets regulation. But the question is, what does this mean for the future of crypto? Experts believe that the next stage of growth will depend not on fluctuations but on trust. If users trust exchanges, trust stablecoins, trust blockchain system, and trust that the law protect them, the industry will scale faster than ever. On the other hand, if regulation is good, a government will impose harsh restrictions that will slow innovation. So the reality is in simple, compliance is not the enemy of crypto. It's foundation of long-term success. Regulation shaping the future. Blockchain finance and anyone involved in this space must understand how financial crime impact global policy decision. Thanks for watching. If you find this video informative, don't forget to like, share, and subscribe to Extra School for more deep research content on crypto, finance, AI, and global economy. See you in the next video. Thanks.